Welcome to Momentum Monday. Today is October 9th, 2022. Howard, how is
This
your
will be our
house?
last event. There's tactical nukes pointed at you and I. Make this
Well,
good, and this could be
it
our
is what
last
it is.
Monday.
Who knows? Maybe you'll survive, Howard.
I'm on everybody's list. I'm on everybody's.
Yeah.
Do you think where do you think Coronado is on the list of nuclear?
Probably number one.
Don't you think it's probably top 10?
Absolutely. Probably
Yeah.
top three. Yeah.
Yeah. So Phoenix is probably last. So I've taken myself out of last place over to first place here this week for the nuclear Armageddon that Biden and everybody's dreaming up for me. So what do we got? And how bad is it?
So last week we had a start of a new quarter, a new month. And the first 3 days, 4 days, there was a lot of buying going on. I mean,
Yeah.
like the S&P, the Qs, they were up 4 or 5% or more. And then on Friday, we got the new jobs number for September, a little bit higher than expected. And it seems like we are in that situation where good news for the economy, for the labor market is bad news for the stock market, since the Fed is looking for the economy to slow down, to unemployment to go up,
Yeah.
so they can pivot. We didn't see that, so the market had a brutal sell-off on Friday. Many stocks gave up their weekly gains, and as you can see here, I mean, this is a chart of the Nasdaq 100. Tiny bounce.
Yeah, it's the way they gave them up. It took so much for stocks to rally just those few days. Like it just felt finally like stocks were trying, and then gone. You know?
Yeah.
So
I mean, it's still in a downtrend, so we're seeing a little bounce to a declining 20-day moving average, and then getting rejected and kind of setting up here for a potential breakdown. And if they break down, it'll probably at some point it will test the pre-COVID levels near 240. So that's about 10%.
Look at the semi. Let's look at the semi. Let's look at the things that like matter right now. Semis.
All right, let's look at the semis. I mean, obviously AMD, they came out with the weak guidance again. And
they're in everything. Like, so like forgetting Intel inside, semis are inside everything that matters to growth. And you have the US at war with China. Like so if you look at CQQQ, like, why are they taking out new lows? Because the fucking their semi industry is under attack by the US. And I'm actually okay with that personally. Like semiconductors are a national so you've got China breaking down, you have semis breaking down. You have the trannies, not the lesbians, but the trannies, IYT.
Okay.
Breaking down.
Transportation.
You've got real estate in free fall. And we haven't even.
Yeah, anything high dividends, really.
Look at this. You have fake pricing breakout.
Yeah.
To 2-year lows in a matter of weeks. And we haven't even started seeing the unintended consequences of these raises. All right, sorry, I interrupted. Keep going.
So a couple of things that really stood out in terms of price action last week. Energy, oil and gas, just alt energy, super strong. Many of those names are actually back near their 52-week highs, believe it or not.
Exxon had its biggest 1-week gain of all time.
Oil and gas stocks.
17% weekly gain, its biggest gain of all time.
Exactly. So they've had some of their best 2 weeks this year.
What's weird is, I was saying, this is a new form of fear. Like young people, I don't even know if this is a hedge. Like, yeah, energy, gas prices going back up.
It could be a currency. Like,
but if you're going into a recession, why are people chasing energy right now?
Well, OPEC decided to cut their daily production by 2 million barrels. And
because they know a recession's coming.
Yeah, and the market knows that the US has to refill the strategic petroleum reserve at some point next year. So there are a lot of moving factors here. But yes, you're right. If there is a recession coming, those prices are not sustainable. Yes. Yeah. It's not a good idea.
This is going to be a complete rolling recession. Like real estate is a huge part of the American market. Like that's been such a misdirection for decades, right? And now you have rates at 20-year highs within a matter of 6 months. And it's just people haven't seen anything like this. I'm 57. I haven't been in a rising interest. I haven't been in my productive life in a rising interest rate environment for, so like, what do I know? So what do these 20-year-olds know?
So basically, if you haven't been trading before 82, you haven't seen really rising interest rate environment. It's been declining. So the other thing that really stood out is that like some of the last bastions of momentum are starting to getting absolutely sold off. Like, I mean, just a few individual names like
we were talking about this. Yeah. These
like LNTH, like Celsius, like these are like the high momentum stocks. Obviously, the market is saying it's a bear market, and in bear markets we have rising interest rates, and all companies deserve to get multiple contraction and much lower PEs than they're currently trading on. So those companies are starting to pull back. We saw the same in the entire climate change.
First solar pullback and EMP.
It's starting to pull back. I mean, still above its 50-day, but it's definitely starting to show some signs of weakness, some signs of distribution. ENPH, absolutely big sell-off, and then tiny bounce. So it'll probably continue to pull back. So as I said, the few names.
No, but look at all the red bars over the last month when the market was kind of hiding out.
Distribution, yeah.
It was selling, yeah.
So the few spots where people like with some momentum hedge funds were hiding, they're starting to disappear, to getting sold. I mean, obviously biotech is holding a little bit better than the rest, but it's a tiny market. You cannot really hide in it, and even there.
Trader, where are you? Like 100% cash?
Overnight, yes, 100% cash. Just taking some intraday.
So pros are 100% cash. Pro individual, I would call you. And I'm 60% cash. I'm not cash anymore. I'm T-bills and looking at 2%. I mean, Robinhood's offering 3% rate. What are people doing? Like, open a Robinhood account, get 3% while you're farting around. Why are you with Schwab earning 0? Like, you may hate Robinhood because of meme stocks, but 3% federally insured, like $1 million. I've distributed this. If you're not earning 3%, first of all, you're done. Okay. When the market's offering you 0, because Schwab's making that spread, and you can move to Robinhood in 2 clicks, and you don't put whatever savings you are earning 3%. You're just stupid, because that's 3%. That's real money. We haven't had real kind of interest rates in, I don't know, 20 years. 3%. I know it doesn't sound like much, but that's real. You do that tomorrow, and you just added 3% to your cash. So if you got 50 grand, 100 grand, 200 grand, doesn't sound like a lot. You move it ASAP. Take the 3% while you wait. Okay, so that's just free advice.
Yeah, Interactive Brokers does the same. I think they offer a little bit more.
But most people aren't going to open Interactive Brokers.
Yeah,
you have 2 clicks, Robinhood, 3% money.
Yeah.
Fully insured.
Okay.
So people need to do that while they're waiting, and now they need to come up with a plan of when to start investing, because we're in here's what I'm worried about, Evan, and I hate being the negative guy, and I'm not negative. I'm just saying momentum's building to the downside.
Yeah, I mean, it would be a good thing to see a flush and lower prices, just a little bit change of expectations, and all of those companies coming out and lowering guidance. This is their goal, ultimate goal. They just want to lower market expectations so they don't look too bad during earnings season, which by the way starts this week with JPM and.
Oh, earnings start this week.
Mostly banks. Yeah, it does.
This is going to be a big week. This is going to be a big week.
Yeah, as you know, the first 2 weeks is banks, after that tech, and the rest.
And like you said, the Fed doesn't even have, now the one job they're saying is to fight inflation. Now they didn't get the number that says it's working. So.
Well, as I said, you're getting multiple contractions. So even if you have a company that does amazing and continues still to grow at 40-50%, that multiple contraction is just growing upstream. So it'll be a little bit more difficult on the long side, not impossible. Obviously, even in a bear market, we will have those big 20-30% bear market rallies. So in a bear market, you have to know to play both sides, not just the short side, because the market is.
Now that we're in a bear market, I have to change the way I talk about this, because we haven't truly been in one that matters. Okay, so we're in a bear market price-wise. We're in a bear market in the sense that people just don't understand this because they haven't seen it. 08 is a bear market, but like most people don't remember it, and most people, like the tech boom really started after it, right? And in a bear market where momentum is increasing to the downside, people should stop thinking about stocks and start thinking about preservation of capital. That's where that 3% cash comes into play. That's just found money that you have to do. You have to pick up some nickels here. The second thing you do is really have to think through a plan, because buying stocks versus, I think this is truly about buying indexes at this point in a bear market. You're like picking stocks is hard in a bull market, but in a bear market, super hard. And so people need to have a plan, because this isn't going to be some kind of V bottom. They're going to have to understand that anything they buy today, they should expect lower prices, right? And so they have to have a plan for buying more at different levels, right? Which is also why you want to take that 3% when you can get it.
Yeah, it's better than zero, but if you have inflation at 8%, you're basically losing 5.
I know,
So,
but
yeah.
but I hate that argument, Ivan, because if you have a job, you have a job, and so your job is save money and preserve capital. Save money, one, and then in a true bear market, preserve capital, which we're in right now. So fuck inflation. You need to get every edge you can, and inflation is inflation. Like at some point they will kill it. Okay, and therefore you want to preserve capital and get as much on your capital right now and preserve capital. Then I want to walk you through some charts. So can we share?
Oh yeah, okay. So let me stop sharing so you can start sharing. Go ahead.
So let me just share. Tell me if you can see my screen.
I can, yes.
Okay, so let's take a look at like the ugliness of in the reality of what people, and you can explain to people some of these shares. In a world that commodities underperform for what, 100 years, there are periods in that long-term underperformance, and 3 are outlined here, where commodities outperform, right? And I think the point of this chart is to say, if we're in one of these periods, they can last for 3 to 5 years. Okay, so asset allocation again matters, especially in a bear market, because you're in the preservation of capital mode. And so everybody's going to start talking, because they have to sell you ideas that commodities are a great play. They're a great idea relatively in the bear market, but you really have to understand what you're buying. But we could be in a long cycle here of, even though commodities underperform over the 100 years versus stocks, these periods of outperformance in the past have lasted what, 10, 15 years? The shortest one being 95 to 2004, and we're basically a year into outperformance by commodities. So it's hard to beat inflation, and we've been in this such an easing policy for 20 years. People shouldn't be so quick to predict when the end of this happens. They should more think about history and how long these things have lasted, and remember that the preceding monetary policy to this was crazy. It wasn't just bad, it was bananas. So to think that this was just going to be a sharp, quick bear market, I hope it is. And everything I say today, I hope I'm wrong and the bull market starts tomorrow. But history says we are in for more pain. Okay, so this is an important chart, because I'm not saying go out to buy commodities, because over 100 years, why waste your time? But man, if this cycle is real, and this is another pattern forming here, you could have 4 to 10 years of really trying to battle inflation and protect your capital. So prepare for a marathon, not for a sprint here. Okay, and I think defense is important. Okay, then not supposed to share this. This is my favorite technical person outside of JC, but I get a lot of research as someone who talks about stuff all the time, and Jonathan Krinsky is a good friend of mine, and I think there's some charts here that he shared that are super interesting. The inversion, the VIX inversion curve, we're not seeing what we saw in 2020 in 08. We're just flipping, like panic is just beginning. Okay. And maybe this isn't a panic that's forming, but if there is one forming, we have a long way to go. Okay. And so the good news is if it's a whoosh, a lot of that happens during the day and it's a blip in a long-term chart. But if momentum's building for some time period, and this chart kind of senses that the panic isn't really started yet. And he's using historical data from this. But I think the most interesting thing from this is this sentiment. Everybody thinks sentiment's negative, but Krinsky goes back and uses the spread between stock allocation and sentiment, and we still have a bullish leaning of 36%. And in 2002, it was 3%, or in 2009 it was 3%, and it was -7 in 2002. So people are saying they're bearish, but they're still super long stocks. Including myself, right? I'm 40% long stocks. Like that's you're 100% cash. So I'm a long way from being.
So what do you own, Howard?
Some indexes, a little bit of energy, and some broken tech stocks, right? Like the software stocks. So I've sold down to a point, 30-ish% in tech stocks of 100% of my. So I'm not 30% of my whole portfolio, 30% of my stock allocation. So I'm really very low, but not smart. Like I'm not like a timer, so I've been nibbling on a few things. But Netflix, Spotify, brands that I think are just worth way more than where they're at right now. So I thought this was an important thing. Watch what I do, not what I say. Yeah, this again, just purely technical stuff, not fundamentals. The long-short momentum, this is what I told you, momentum seems to be increasing in the growth names to the downside. What else was I going to share? Again, so the stuff that hasn't really broken, Apple, Tesla, now Bitcoin, now ARK, again to new lows, the stuff that like momentum still seems to be hiding out in, GME, like all the meme stocks are broken, but GME has it, Tesla has it, Apple has it. Trump is still trading at $17. I know it's down from like 180, but the thing's fake and it's still above 10, and there's not going to be a deal done, right? It's really a zero. So they're still hiding out in the edges of this. And listen, if we turn, Tesla's going to be a new leader. But if this is the last hiding out places, you could see a whoosh down on this thing into where were we in the 70s or 80s. Stocks at 220. Right? It doesn't mean it's a bad company. It's just a revaluation of everything. Again, ARK. She hasn't like she's now launching a private equity fund.
Yeah.
The thing's down 80%. She's still like the expert on all things. She's like underperforming the Qs over 5 years, and now people want to give her money to tie up for 10 years. So this is not the things that happen at bottoms. I've been harping on this. I don't even want to talk about Bitcoin. I feel like people are chasing energy here, like it's some weird safe haven, because they've never seen, they just like somehow, I just don't buy into it, but I am along a little bit of energy as an index. And then, like I was saying, Exxon largest weekly gain ever. That seems weird. Gasoline threatening a new leg higher, and then this is interesting, small cap value over again, there's no signal yet of a breakout, but like because everything will come down if we keep going down, but like there is a changing of the guard, right? Like when we enter this new bull market, it most likely won't be FANG. And small cap value seems to be a place where people that are paid to do their job and find alpha are like combing through, using their time right now to comb through balance sheets and stuff. We talked about earlier, REITs are at a critical level. I mean, fuck. I mean, that's a huge hideout for huge money. And guess what's doing well? Casinos.
Yeah.
So it's like, I don't know. All right.
Because of the Macau reopening, that's why the past.
Okay, but like casinos technically are improving. You're getting into fundamentals. This scares me because this is, who knows how the Chinese will react if they care, but like China's cracking after already down 60% of an index. It's taking closed, and the US is targeting semiconductors, right? Like that's China's bread and butter going forward. So there you have it. Like technically, I think people need to see that. Again, I'm not a technical guy, but I love reading it. And this CPI thing, a couple more that I wanted to share. I can go through them. Share. Nobody look. This
Sure.
is the Can't Stop, Won't Stop. This is like a bunch of covers this week.
Yeah.
We're just, you know, like the US dollar is a safe haven at some level, but let's be honest, like this is going to reverse awful at some point.
At some point, yes.
Yeah.
Yeah.
And I think if we flash back in the next few years, like this cover will be laughed at. And then, you know, this is great. I always link to Rotation Report. He's a great writer. I love the way he says real estate isn't handling the transition from fake prices to real prices very well. There is 0 S&P stocks in the real estate sector above the 200-day moving averages. Okay, Lord knows what schemes are unraveling before our eyes. I mean, this is really, as a technical guy, this is just price and momentum. This is a problem. Like, you know, I was doing a bike ride around Phoenix, like my 30 miles, and the amount of homes for sales is definitely increased.
Are you looking for a new house?
No, but I ride, and so you see all the I ride through 6 or 7 good neighborhoods, mixed to good neighborhoods over my 30 miles, and I ride so often, I notice home sales, and there's a lot of stuff for sale, and usually
it's a highly leveraged industry, so just a little deterioration can put a lot of people under.
And Phoenix is great and it's diversified now, but not every neighborhood is good. And it is a desert. In 7 months of the year, it's super hot. Like it's still 90 degrees in October. So not every place in Arizona deserves a premium real estate price. But the other thing I noticed, I'll kick it back to you, is this fascination with tech, the metaverse. You know, I've seen the numbers on this Decentraland. People were buying land in the metaverse, I don't know, 6 months ago, 3 months ago. I don't know if you follow this. There's 35 active, like the prices are all down like 90%. And I want to give people an anecdote here. You know, after spending a month in the Alps riding and really getting into cycling in the business of cycling. And I don't know if you have a bike. Do you have a bike?
I don't.
Okay.
It's not my thing.
So, but biking is not for everybody. Okay, but let's assume 40% of the population could bike to work or bike as fitness, but don't because they're scared of the roads. They don't know how to ride a bike. Maybe they can, but they can all afford a bike. They may not be able to afford an e-bike. You have all these people focused on the metaverse. But I was riding for weeks in the Alps, and I was passed by more 60, 70-year-old people on e-bikes than are on the internet. Like relatively to those people like being pitched that for the valuation that we have to get these 60, 70-year-old people onto tech versus how many people are already riding e-bikes. So the amount of misallocated capital when there's just tens of millions of bikes to be created and sold, and the tech in the bike industry is just getting started. So in a world where there were 2 types of bikes, a mountain bike, and that's relatively new, to a road bike. And now there is disc brakes, which is a relatively new innovation, which is an incredibly safe way to brake on a bike electronically. And now you add gravel bikes, which are just road bikes with fat mountain bike tire, which is an incredible innovation and brand new innovation. I've just switched over to gravel biking, and then e-bikes. So there is bullish industries in the real world that are basically $1 trillion industries that are still nascent, right? And so on the other side of this, climate, and this goes to climate change and everything else and repurposing the Alps. The Alps is open. Their best seasons are winter. And in a world where global warming is happening and ski seasons are worse, that whole Alps area needs to be repurposed for fall and spring and summer, which is an e-bike place. So a lot of these resort towns and tourist towns close in the summers, and their whole business is based on skiing in the winter. And so there's a whole huge 6-month season, 5-month season that can be dedicated to hiking and biking. So I think there's industries that matter that are going to change. Not everything should be about refurbishing your home with restoration hardware. So I do think there's a lot of non-metaverse, non-tech things that are exciting. All right, so that's the end of that. What do you go back to your? Let me just unshare.
All right.
This real estate stuff, Ivan, is real issue.
Okay.
Yeah.
I stopped you, so let me share my screen. Yeah, of course it is a real issue. It's one of the biggest markets in general. So I mean, I mentioned what I'm seeing, like the tiny bounces, market is making lower highs, potentially threatening to break down. And if it breaks down, as I said, we have probably 7 to 10% lower, and good likelihood of revisiting the pre-COVID highs at least. And then some people even have a measured move to until 3,200 for the S&P 500.
It is a swing trader. Are you looking at long? What are you looking?
I'm looking for both longs and shorts, and if I take a swing trade, it will probably be with an option, because there's just better risk control. I know that stock can gap, but when I buy premium, I know the exact amount that I have at risk,
Totally
which is the
agree.
entire premium.
Yeah.
So if you're taking overnight risk, it kind of makes more sense. At least to me.
That's as a professional trader, and I'm not. I totally agree with you. So you're using weekly options?
Yeah, weekly, sometimes monthly, it just depends on the
long
situation.
side, what sectors, what kind of stocks are you looking at?
Long side is just energy and biotech mostly.
Okay.
And short side, as I said, all the momentum names of this year are now just starting to break down, and I think they might have a lot of room to fall, just based on valuation reasons. And if the market starts caring about valuation, which there are signs that it is, those stocks can drop 40-50% very quickly.
Yeah, my thesis for indexes there, I don't know if this makes sense to you, is what would take people, and I think it's just a reallocation to bonds and real estate. So if people took 20% of the money they took to high growth, right? Like, people aren't going to sell Apple. They own the Apple's in the index. So the only thing that could happen is people say, shit, I can move some money to corporate bonds, my 401k and small caps and REIT for the first time. And where does that money come out of? The S&P. And what do they have to sell on the S&P? Apple. So, like, the only way I see Apple going down is if people sell indexes. And there is a possibility as rates go up that this is what the perfect storm for indexes is. People just lighten up on the S&P 500 because they want to put money in 6% corporate bonds or 7 or 8% corporate bonds or treasuries for a few months. It's just a click of a button on an IRA. It hasn't happened. It may not happen, but that unfortunately is the shoe that hasn't dropped on this indexing world, or on this S&P index world. And that's the unwinding. It's not about Apple specifically. It's just people saying, get me out, and reallocation of their long-term money. And it may not last for long, but it can also last for 20 years. Once people click that box and just say, get me 6% bar, you know what I mean? They don't unclick it very fast,
Yeah, I mean, it could be a big tailwind for bonds, and the opposite for stocks. But
yeah. Anyways, I just want people. I don't want to be negative. I just want to people need to understand that, like, they're used to these short bear markets, because I don't remember 2000 to 2004 in tech, or 99 to 2004. That was a long period, right?
yeah.
And blockchain ain't saving us. Blockchain ain't AWS. It ain't YouTube. It's not Twitter or LinkedIn, but like, there's just no users over there. The blockchain is super fascinating, but it ain't gonna pull the world out of a bear market.
It's very early, but it'll take, a little bit more FOMO and liquidity for it to work.
And users. Like I
Yeah,
said, like people are using e-bikes more than they're using these, the blockchain. So I'd rather bet on cycling and e-bikes than the blockchain in a bear market right now.
yeah, it might happen. I mean, did you see
Will happen.
the PayPal
will
news from today?
No.
That's the-
Yeah.
they want to fine people 2,500 if they misinform. Like, this is a huge case for someone building social media on top of crypto, so people own their
Yeah,
web
we're
personality.
still a
So
long way, and they're not just randomly going to take. Again, this is the kind of news that gets people all up in arms at times like this. And I'm not saying it's good or bad. It seems like a total buster by PayPal, at least from a PR perspective. But I don't think it's like the intent was to steal $2,500 from millions of people, versus crypto, which basically is created, take $2,500 from everybody. So it's like people are up in arms, but they should keep that in context of what PayPal is versus crypto. All right.
It's too long. We made it too long.
Thanks for letting me riff. I appreciate it, everybody, and we'll see you next week.
See you next week. All right.